Hi, Richard Hemming here from Under the Radar Report. I'm chatting with Luke Winchester from Merewether Capital, who also specialises in small caps, or really sort of micro caps almost. We're doing this regular series 3+3. The last one got a really good response. It's been a couple of months. There's been a lot that's happened since we last talked. I mean, almost too much to mention, really. So what we're going to do is just talk stocks, and then the rest will filter through. This week, we're going to start off with water stocks because we're both into water, and also because we've both done pretty well out of the first stock that we're going to talk about, Vysarn. And I think Vysarn's a really interesting story. Luke, tell us about Vysarn.
Yeah, as you said, done well out of it. We've held Vysarn in the Merewether Capital Inception Fund for nearly 3 years now. I think halfway through 2023, we took a position in the stock, and it's a good example of a micro cap story that evolves over time, Rich. As you know, it's in that water space, started its life in the dewatering side of things for mining services. And there's a good business there. I mean, it's the sort of business that, the market doesn't always resonate with. It can be cyclical, a bit capital intensive when you've got to run these dewatering rigs. But they had about 12 rigs in the field, all with tier one iron ore miners. And so it sort of underpinned a nice steady stream of cash and profitability. And sort of why I liked the stock back then, and it's really played out since, was management had a pretty clear strategy around that whole water space to just, flesh out their offering across the broader water services, not just in mining, but also moving into infrastructure, agriculture, places like that as well. And so they've done that through organically in acquisition. They've built out some other segments, built out some other verticals. That core industrial business still dominates the reported numbers today. It's about 60% of revenue and roughly about the same of profitability as well. So that can bounce the numbers around a bit depending on what the big miners are doing. We know they can sort of ramp things up and down on conditions. But yeah, in that water services space and doing quite well. And the real blue sky for this business, and it's always been difficult to price this into the stock, although no doubt it's starting to come in a bit more, was they've had this grand ambition for a while to run what they term an asset management segment, which is managing water as an asset. So the closest comparison we can really give people is similar to what we have is over here with the Murray-Darling. So you've got the Murray-Darling Basin.
People have made a lot of money out of it.
Yeah, you have water rights, you have tolling on
not sure
per
how
gigalitre.
much of it's like been disclosed, but it's certainly been a big money maker for a few years.
Well, it's been one of those real alternative assets. So you've seen a lot of managers in the space and funds in the space, but there's nothing
private funds, I think.
Yeah, well, yes, and partly because you sort of need that long-term sticky capital in this sort of space. But there's nothing like that over in particular the Pilbara, and so Vysarn had this idea. They partnered with a Indigenous group over there. It's a 50-50 joint venture. And so basically what they've done so far, and they're quite advanced through the process now, they've found a water resource under the ground, they've scoped that out, they've put their licenses into the WA government to effectively apply for how much water they can get out of the ground per year. And then the next step is obviously finding industrial customers to offtake that water, mines and big plants. But there's plenty of demand over there. The alternative is.
But they're already paying. They're already paying fees, aren't they? Those miners.
So
it's a change isn't it?
It's sort of upending.
They're kind of looking to disrupt.
It's sort of upending the existing system. There's a bit of risk to that. I know you understand that as well, because it's bringing in that sort of tolling of the water. So
rather than a flat fee, more
rather than allocation of the water, it's being tolled. So
there's going to be a bit of pushback there.
There'll be a bit of pushback. The overarching theme, though, for this stock and for the whole space is there is a water shortage. It's something that needs to be addressed. Vysarn think they have a solution, maybe not for the whole problem, but for a part of it. And you can sort of look at the Murray-Darling and other areas at what they have in the ground, how much they can get out per year, and then rough numbers on what they can charge with the revenue. You can sort of get to some back of the envelope
because that's the
numbers.
whole point of this stock. is the valuation side of things, because it's done so well. But let's face it, that actual business isn't growing that, at a fast rate. Like it's very skewed, and they went on, they made, what did they make? 20 million or something for the first half, was it?
Yeah, they were on track to make 20 million for the full year.
Oh, for the full year, sorry.
About
So they were on track to make, and they were kind of trumpeting how well we removed the first half skew. So, I mean, really, it's a business that is quite low margin. They've got their foot on a water resource. What do you pay for that?
That's the hard part. And like I said, so it's an interesting case study in how micro caps evolve, because, bear in mind, nearly 3 years ago when I first bought the business, you were paying, call it 8-10 times
you're paying
just for
really,
that
when we first looked at it a couple of years ago, it was kind of like, they had all these kind of fingers in the pie, or these little strands to their business, but really, the consulting business hasn't paid its way.
Not yet.
I mean, and you're thinking, well, that's like just sort of trying to get an avenue for getting business in. But like the big thing about this business is it's kind of crash or crash through at this point. Like how much, would you be buying it right now, Luke?
Look, for the fund, we haven't bought any for a while. We've sort of had our allocation, and if anything, we've taken small profits on the way up. It is hard because it's a different style of investment. You know me, I'm more of that real value style. So a few years ago, when you could buy just the earnings of the industrial business and have some blue sky, I love that. Now, as that blue sky is being priced in, it is closer. Like you can see the steps being made towards sort of getting this asset management arm off the ground. But the warning for investors, and I'm one of them, obviously, is even as those steps progress, and if there's no disruptions or hurdles, you're still looking at FY28, FY29 before anything comes in, because you're talking about building pipelines across the Pilbara, like big infrastructure projects. That's the
kind
risk.
of like kind of mid to late teens multiple now from my memory.
The businesses we sit here today, be even higher.
Maybe
from
20, 22,
23.
Exactly. So you're paying a rich price.
You are.
But what we would say to people is just if you're interested in the stock, I think put your toe in the water and just buy a bit, just to be kind of more cognizant of everything that's going on. This is what we do typically if we're not 100% on the valuation. Just get your toe wet. But I think we're saying just watch this space. Really, is that sort of the?
Oh, look, I don't think the downside's immense, because you do have an operating.
They do
business
have a good balance sheet.
Yeah, good. Oh, great balance sheet.
Yeah, so
good,
that's one
good
of
operating business.
One of the things that we really look for, isn't it?
And I think the upside downside skew is still very much in your favour as an investor. So if the asset management arm pays off, I think the upside's multiples, whereas your downside's not as much. So from that point of view, but it's a different, as I said before, it's a different investment proposition, and you would almost liken it to a mining explorer bringing a project online. You know the potential's there, but it's the application risks, the capital risk, the construction risk, all that sort of stuff, and it's then how do you balance, what's under the ground, getting it out and monetizing it. So, one we still like, and it's still a decent size in the portfolio.
Okay.
But bear in mind, our average entry was 10 cents. 3 years ago, it's 70 cents today. So it's certainly grown over time, and I'm not rushing to add to it today, but still obviously like the outlook for the business.
And I think one that's on the other side of the spectrum in the water space, one that's come from $1 probably a decade ago to being under 10 cents is Fluence. It's certainly been through the ringer, Fluence. It's been around for 18 or 19 years. A company that has operations in loads of places in the world, and they do a filtration type technology. That's their core technology. I think what we've seen is the emergence of a company that's now got a firmer handle on where they want to go. Whereas before, they were doing these big projects, like they did one in Egypt, which I don't think they ever got paid for. Well, they probably wanted to get paid for it, but I don't think. I think that's not to say they weren't successful. I just think the government said we're not paying you. Then the one in Africa, I think that's still on the balance sheet, and they've kind of got through that Ivory Coast business. With sort of almost unscathed, but it's tied up a lot of capital, it's tied up a lot of resources. But now I think they have this Maber technology, which is a modular type technology, which they want to roll out around, in particular in municipal kind of locations around the US. So they, like all these companies, they cite these huge market potential of 200 billion. It doesn't really mean that much if you ask me, because as we stand here, they've got one contract in the US as far as I can see. But I think what they do have is a firmer financial situation. So they had this really onerous kind of distressed debt situation where they were paying like $30 million of onerous interest, 18% plus. And I think the directors refinanced that. So now it's directors' loans. They've got skin in the game, the management. It's got a young guy who's heading it. I think they've got, there's a lot of potential there if they can roll their technology out, but the risk is definitely there. But the balance sheet's a lot stronger. So that's why I think it's probably, Vysarn circa 3 or 4 years ago. But any thoughts on Fluence?
Look, it's an interesting business. As you said, been around for a while, listed for a while, and you summed it up well. Like, it's a business that's never struggled to generate revenue. I remember looking at it a while back, and it had years where it generated, close to $100 million in revenue.
They got like around 80 million last year. Now they're kind of looking at around 90 to 95 million. This is US this year. So I guess that's where we're talking about an improvement in revenue, circa 13%, without the Ivory Coast. So I think there's a genuine improvement there, not just surf. So that's probably a bigger improvement if you look at their core operations.
And I think the key, like that's a huge revenue base, and it's a massive stepping stone to launch from. But the issue in the past has been it's been unprofitable revenue, and very low gross margins and very high operating costs. And then you summed it up well. The balance sheet really came under stress. You got these large projects, and you're upfronting a lot of the costs to build. These governments are dragging their feet.
Sovereign risk
massively
out of your ears.
They're dragging their feet on cash payments.
I think the CEO met with the LCC, the head of Egypt.
Oh, really?
And I thought, I said you'll have hundreds of meetings in your life, but you'll remember one of them, and that's one of them.
True.
I said, but getting money from him.
Tricky one.
I wouldn't bet your shareholders money on that.
No, but no, look, I mean, the fact they were generating that revenue suggests the tech, something to the technology.
There is something, because they've got some huge competitors in the space. But if the technology's up to it and they have a modular niche, then they can get business that is not economic for these giants.
And that's the key now is management. And as you said, skin in the game is huge. And they're credentialed. I mean, it's now effectively a US-based management team,
definitely.
Looking to pivot it to be a US-focused business. They know that market because the name escapes me, but they're coming from a peer over there in the US and effectively, trying to grab Fluence and just run back the playbook that they've done previously. So, no, look, I think it's super interesting.
They've got a bit of skin in the game.
That's key. I mean, with comparing it back to Vysarn. Vysarn's got an executive chairman who owns 15% of the stock.
That's very much run like a kind of a private company. Vysarn.
And so, but you got that skin in the game. And the other one as well is you had a really, like I said, what attracted me to it a few years ago, a really clear strategic vision about what they wanted to do. It was we have this core segment. This is our broader space, and they'd actually have like a circle in their presentations, segmented like a clock with all the different water sectors they were looking to target. And then it was either organic or acquisition. How we would broaden ourselves across this whole spectrum. And I think Fluence now has that.
Well,
you've got management.
They're getting there. They're much further down the curve. So moving on, I think. Would you buy Fluence, by the way, Luke?
It's on my watch list.
It's on your watch list. Okay. Well, that's the biggest recommendation we've heard from Luke on Fluence. The only real recommendation. But let's move on to another stock we're both familiar with, one that's had its ups and downs. It's been a topsy-turvy ride for LaserBond, but we all like an Australian manufacturer.
Yeah.
We all like a surface engineer. Well, a lot of us do.
Some of us do. Yeah.
Let's talk about LaserBond. A great name.
Yeah, it's a really good name, actually.
It's got a good name, doesn't it?
I caught up with the management team post reporting, and they made the point that the name's almost like a verb in the industry. Like, people say with regards to laser cladding, get it laser bonded. Like they've got that sort of.
Look at
yeah,
that.
which is pretty cool to have.
Well, at least in Western Sydney they have that.
Yeah,
in Queensland.
Smeaton Grange. Yeah. But no, look, another one. We've owned this since the inception of the fund, but even personally before we launched the fund, I've owned this since 2018.
You've seen some exuberance. You've seen some bearishness. Where are we now?
Well, it's interesting. Let's go back and unpack that, because I think you're spot on. And anyone who looks up a share price, 10-year share price chart, the share price has had its up and downs. The actual business itself has been relatively steady. The last couple of years, profitability took a bit of a hit. It remained profitable. It never actually lost money, but margins took a bit of a hit as they were sort of going through an investment phase. And
they do. Just to be clear, what they do, they're basically surface engineers. But big companies use them. Big OEMs use them, like manufacturers, to sharpen their tools, to increase the wearability of their tools. So they're a good company for saving other companies money.
Yeah. So
that's why they like the US is a potential.
The big two big benefits for customers. Yeah, saves money because it can increase the wear life of some of this heavy machinery, 5 to 10 times. The other one is, everybody's trying to increase their ESG credentials, and it does that because you're remanufacturing rather than purchasing new. So, and look, LaserBond, they've never struggled for demand and growth. Where they've sort of
the sales line's not that big in the whole scheme. It's
it's
50 million.
It's constrained by the capacity in the business.
Right, exactly. So you're saying the demand is always there.
And so they've been constrained by
capacity.
And sort of go back to what I was saying before, the business has been quite steady, and particularly at that revenue level has been quite steady. And where they took a bit of a hit to margins over the last couple of years was really fleshing out that capacity. So they expanded their Queensland facility. They really invested in skilled labour as well.
But they had their Queensland facility, didn't they have a facility in Asia? Or,
No.
So basically, they had people come from. They had workers coming from the Philippines or something. They were basically caught short or something when a customer said, "No, we don't want." I think there was just in
general. I'm not sure if there was a specific customer, but just in general, like it's one of those businesses that relies on skilled labour.
It does,
like a lot of industrial businesses, it's a common theme from you speak to any of them. The hardest part of the business is finding and keeping good labour. LaserBond hasn't had too much of an issue with the keeping. It's the finding, and so they a couple of years ago set up the visa pathways. And that's a big investment. Like it's actually, you've got to spend a bit of time and money and effort to set up the correct pathways to start bringing over visa immigrant labour. You're right. Their first batch, for lack of a better word, came from the Philippines. They're now sourcing labour from South Africa as well, and also always trying to supplement it with apprentices and people like that locally. But it is that number one constraint for them. So the best way to highlight it was it's a business that it's got facilities in Queensland, New South Wales, Victoria, Adelaide, and an acquisition in Perth. And in all of those facilities, up until last year, they were running just one shift, which is just the day shift. But they've had this capacity to run afternoon, night shifts as well, and effectively double the output of the business. But labour was always a constraint. So now they've sort of started to unlock that a bit. Queensland was running an afternoon, night shift last year. They're now rolling that out to their other facilities. They've set up those visa pathways. You've got a much steadier cadence of labour coming over rather than sort of having this big disruption where you've got to bring over 10 people at once, train them all up and sort of have that productivity hit. So anyway, long story short, I think the business is in a position where it's probably in the best position fundamentally it's been ever, maybe. National.
Well, what about the US? Because that's been, they've talked about the US being, a logical kind of extension of the business, and they've backed off because of tariff reasons, and then they had the kind of.
So they pressed pause on that.
So they pressed pause, but what do you?
I think they'll head back there.
Sort of talking about it, but it's not something you could put on your investment, in your numbers at the moment.
No, and look, I view it a lot like, go back to that conversation on Vysarn. Like the way I view it is you value the business on what they have today, and you say, well, if the US is over there, if they make it work, it's the blue sky. But I'm not going to price that in. I'm not going to value that.
And what do you price sort of LaserBond in at the moment? Like, is it because it has had a bit of a recovery from some pretty low periods, hasn't it?
So
it's a business I'm loath to pay too much for, because it can bite you, because I guess it's a bit of an education for everyone who's investing in LaserBond, how hard it is to be a manufacturer. Like, it's not easy. Like, it's not like, you could do some software and just roll it out, stuff like that.
So in general, your capital intensive, cyclical, mining services businesses, you've got to be careful paying any more than 10 or 12 times earnings. Where I would say LaserBond is a little bit different, there's some real IP to what they do, and where you see that more than anything is in their gross margins. They did 58% gross margins in their core services business in the first half. So that's a really good indicator that they've got a sustainable business. Exactly. So you would put a premium on that. Now, how much? That's the question. Yeah. So rewind a few years ago when that share price got a bit exuberant, as you said. The market, it was 25 times earnings. Yeah. That's too much. Yeah. So
the market did get exuberant on the US potential, I think.
That's right. And the business was just executing well. Like, you've got a business that has a few different product segments, a few different geographies, and most of the time when you have businesses like that, not everything hums at the same time. Like, one of your segments might be a little bit slower than you'd like, another one's doing okay, one geography's doing well, one's sort of, bit behind. But put it all in the wash and the business is doing okay. So they went through a period where everything just did well. The US was on the cards, and you're right, people just got a bit exuberant.
It's for me, when they start pricing in the blue sky, exactly as you're saying, Luke, that you sort of, you think to yourself, just take a breath, take profit, take a breath, depending upon what your entry price is, but don't get carried away and buy the hype.
So for me, I've always sort of just had 15 times earnings as my rough.
Well, that's a pretty sensible.
I think so.
And what is it at the moment?
Well, so where we are right now, they just reported 2.5 mil NPAT for the first half. It's about a 60 mil market cap, but. The swing factor for earnings to this business, particularly FY26, which we're in right now, is they've also got this segment where they license that technology I was just talking about. So they've got this good technology, generates really good margins, and they've had this idea for a while of, we've got two ways to sell that IP, which is we establish a factory ourselves and do the work, or two, we license our IP directly to the manufacturers and they use it. So they signed.
They've talked about that license thing a lot, but it has it.
So again, like they stubbed their toe with it, and I'm always forgiving of companies that we've been in microcaps for years. We know what it's like.
Like it's exactly. So you've got to look at these bumps as opportunities.
Where they got it wrong was they were going to these customers and saying, "Yep, you want our technology. What do you need it for?" And the customer, we're doing this, that, and the other, and they were building these really bespoke laser systems for them, and it was taking months and months to build and. They had to source, supplies from all over the world to build these customized lasers. And so the board basically went away and said, scratch that, we're going to refocus the segment to modular off the shelf. So a customer comes in, we've got a catalogue that says, here's our laser cladding system, here's the basic, you can add this, and that's it. No customization, no whatever. And I'd again, go back to that blue sky conversation and not pricing it in too much. I hadn't, I'd sort of put that to the side and was focused on the main segments. And then the AGM last year, they announced they'd signed a $2.3 million deal with Komatsu, one of the biggest OEM.
But they haven't said when they're going to get paid. It's
So
frustratingly opaque, their comments. And the new guy, this guy heard like, oh, we got this guy coming, this new CEO.
Yeah.
And I thought, oh, great, a breath of fresh air. But he does talk management speak very well.
A little bit.
I'm sure.
Look, part of the problem is
he knows not to overpromise.
It's commercially sensitive as well, so they've got to be a bit careful about what they can say.
I'm not saying it isn't, but it's just like for mine. I just want to see what happens there before committing more funds.
I think that's fair. So they've said that they expect that system to be rolled out in the second half. So, you'd assume revenue recognised in the second half and then cash, 30, 60 days, whatever the payment terms after that.
Yeah.
But this is the big but to it all, and where I think the market, and like yourself, maybe just on that sidelines until we see it, is this has happened in the past where, as I said before, they'd announced a technology license sale, they've got a customer, and then, when the report comes out, we had some modifications, we had some delays, we had some whatever, and the unit wasn't delivered on time, so it got pushed into a later segment. So I think you're right. I think there's people sitting there like, we've seen this story before, let's see this Komatsu thing pushed out. But, to go back to circle that conversation back to valuation, I think if everything goes smoothly on that front and they recognise that revenue in the second half, probably does 6 to 7 mil NPAT for the full year and trades on 10 times earnings. Big ifs in there, I know, but
let's move on to another technology-based sort of company, Nanosonics, which we won't talk on for as long because Nanosonics has been around for a while, and a lot of people would know Nanosonics, I imagine, because they are a specialist in sterilizing probes across mainly America, but also Asia Pacific and Europe. But America's the big driver. The Trophon product has great kind of take up, and then they're improving it, so they're like got next gen Trophon 3 that they've introduced. So there is growth there, but I guess the big growth is in the endoscope cleaning product Chorus, and that's where I guess the frustration has occurred. And with Nanosonics, like, they are a quality company, they have a global franchise, they have 160 million cash on the balance sheet. They have basically, they spend 15-20% of sales on R&D. So they have like huge pluses. The one thing, they don't pay dividends and they're priced like a growth company. So the volatility in the share price, like 1 minute everyone thinks it's going to the moon, the next minute people just are crying into their hands or whatever they're, I find this stock fascinating in that I really bought into the whole Chorus endoscope kind of potential, but it has taken a long time. But now that I can see the potential coming through, people have just decided, the US dollar weakness, that's impacting their Australian dollar profitability. They can see they see headwinds. And as a kind of investor, I think, well, that makes it more interesting to me because Chorus is being commercialized at a slower rate, but we are seeing that it's going ahead. So instead of trading on 40 times cash flow multiple, like, enterprise value to EBITDA, it's more on 20 to 25. So for some people that are pure value, they say, well, that's still expensive. Whereas I would say, but look at the quality of the company. You're never going to get it at a bargain basement price. It's always going to be, have a growth premium attached to it. What are your thoughts?
No, I agree with all that. It's an exceptionally high quality business, and I mean it's put up. Its business model is used to describe other businesses on the ASX that run.
It's another one that's a euphemism. It's the LaserBond Nanosonics.
They do.
We are investing in companies that are so good that people use them to describe other.
They do it so well. I mean, they really establish this razor blades model in the ASX of high margin units themselves, but then just that ongoing revenue of consumables every time something sterilized.
They've kind of like
they make good money.
They've made it into a fine art. Like normally you would think that sterilization, the kind of product, would just bore the living daylights out of you. But if you see what they can do in terms of the numbers that they can produce and the global franchise that they've managed to achieve, it ticks the quality box on a number of
100%.
levels.
Yeah. And that's why I agree with you. Like, the way I would think about the business, and it sounds like you're the same, is let's back out, the money being spent on Chorus and just, value it on the core.
On the Trophon. That's
business.
what people have looked at it when the glass is sort of half full. That's how you kind of really have to value it.
I think your numbers sounded roughly right to me as well, 20 to 25 times earnings, because it's still growing. It's not a hyper growth business anymore. It's starting to mature that market that it's in, but essentially recurring revenue.
But the point is, you're not paying for that.
Exactly.
That's what we keep coming back to.
Yeah,
isn't it?
And there's no capital reinvestment. If they wanted to, you would get huge dividends out of this business because it gushes cash.
They're not really going to get franking credits though, and I suppose that's because that's the calculation the board makes.
Exactly, and management of the board is sitting there going.
So I think Nanosonics, quality company, one that you could easily put in your portfolio and not lie awake, because like sometimes with these companies, and I just like when you're paying 35, 40 times PE, you can see just to go back to 25 PE or whatever, or 30 PE, you can see 20% of your money you'll never see that again. There's not the fundamental value behind the valuation. So I like companies where you're not paying up for growth. You're not paying too much for growth in any case.
And that's a lesson that's been learned by a lot of people over the last 6 odd months.
We're learning that every day.
Overpaying for growth has hurt a lot of people. I completely agree. And I think it's a great business, and as long as you're paying,
it is a great business, and that's what we're about. We love great businesses. Speaking of which, here's one that I don't know much about: xRealityGroup. Can you just tell us what xRealityGroup is, Luke?
Sure, and I think you'll like this one, Rich. I think you'll like this one. So, this is actually the old indoor skydive.
Oh, I think you've mentioned it to me in the past. Because I want to do a company visit.
Yeah, they're in North Sydney.
I love doing it.
I think you'd enjoy it.
Probably could be the last company visit.
But so anyone who's been around in micro small caps for a decade or plus,
we remember
the old indoor skydive. So
yeah.
if you're out at Penrith, they had one at the Gold Coast as well. It's the big wind tunnels, and you go in and do it.
Good for the kids as well.
Yeah, good sort of, and so they still have that segment. It's what they term their entertainment segment.
Yeah. That's what they do focus on it a lot in their report.
Yeah, well, it's still a good chunk of revenue and generates good
material,
cash. So they report on it. But so where the excitement for this business is, and it's a bit of a pivot, I know, but bear with me. I'll sort of go through the history very quickly. So it was founded by some ex-SAS soldiers.
Oh, right.
The business, yep. And they were doing some VR stuff inside the wind tunnels. So they were helping Defence Force and Air Force staff simulate skydiving into a combat zone wearing VR goggles.
Oh, right.
And they had the idea of, taking that VR technology and broadening it. So what they've created is a segment they term enterprise, but realistically it's one product, which is called Operator XR, and it's virtual training for law enforcement and defence.
Oh, right.
So you wear the VR goggles, sensors on your body, sensors on your weapons, and then they simulate thousands upon thousands of different training scenarios and things like that, fully customizable to whatever the customers need. It sort of helps these personnel get some experience in scenarios where obviously you might not get to see them too much, but it's very important that you sort of know what
they
you're
put
doing.
people in flight simulators a lot before they go
exactly
before they go up to the moon.
So they launched this segment. The first iteration of Operator XR was only launched back in 2023. A few years ago. They've now launched the second generation of the product, which is really getting some takeoff, and in particular over in the US. What I like about it, two things.
So it's making money. It's being commercialised.
Yep. So it's now taken over the entertainment side of the business.
Oh,
so
right.
it's a bigger segment now.
In revenues and earnings, or
Both.
so it's quite high margin.
It's 80-something% gross margin.
Yeah.
So obviously the physical hardware, it's just off the shelf VR goggles and sort of sensors.
Yeah.
But so all the margins in the software, the underlying software. So it's similar software type margins, recurring revenue as well. That software portion.
But how many customers do they have? Is there customer concentration? Because I mean, you're dealing with big governments, aren't you?
Governments and defence. So right now they have they actually just crossed the threshold. They've got 100 separate customers. That ranges from small sheriff's office over in the US to the Department of Defence in the US.
Yeah. So from Brian Dennehy in Rambo,
yep,
to some of the
Colonel so and so.
Well, yeah, too.
So they've got that whole spectrum. So you're right. They do have a couple of large customers. The two biggest ones are Department of Defence, and they won a contract with the Texas Department of Safety as well. They're big contracts, but only
Texas is a big area.
Well, Texas is big. So that was a $4.3 million contract on its own.
Well, that's great.
And there's 30 other
and
of
do
those
they have like
public safety departments in the US.
People going around.
So again, I told you you'd like this one. So you're getting ahead of me. One of the other things I liked about it is I think a lot of times businesses, like everyone looks at the US and goes,
they salivate.
It's 100%. But what they'll do is they'll partner with a distributor or someone like that just to try and get that immediate, we'll go with them.
Yeah.
These guys, credit to them, they've toughed it out, building their own internal sales force.
But that's got to be a lot more comforting for sharavholders.
So
I would imagine
you get 100% of the benefits. You're not handing out cuts to distributors. You've got better control over your sales process, your support process, all that sort of stuff. You're not relying on distributors to do that. And it's really interesting. So talking to the CEO, just the way they manage it. So basically, it's just incremental in the US that they'll win some customers, generate some cash and some revenue coming in, and they'll go and put on a new sales staff, and then it's just this build. Yeah. So I think now they've got 5 or 6 sales staff over there, and obviously split them up geographically. But yeah, it's a huge huge market. There's
the Midwest,
18,000 sheriff departments, police departments in the US.
I mean, it's like the next catapult.
Yeah, I mean,
only instead of elite sports teams, you've got got like something out of Blade Runner,
police goggles. But no, look, but it is one of those things. Like, as you know, these sorts of government type businesses or just like public funding.
Once you get the money,
but also they talk to each other.
Yeah,
they talk to each other. So it's you win one, and the next time it's reference customers and all that sort of stuff.
And so when you said obviously it's off the shelf, where is their IP? With the VR goggles and stuff. The actual kit, like they're not going to be doing that.
Yeah.
What's
so
their key?
The hardware itself is pretty generic. I think it's a HTC goggles. The sensors are all just generic. So the IP is in the software that creates the scenarios and marries it all up.
So how do they come up? Like why are they good at coming up with that? Because lots of people you would think, like there's so many games like kids go crazy on this stuff.
So a few things, and
Fortnite,
none of them,
like that's like old bag now. Like they've moved it on since like it is literally a gamer's because they're in the gaming world sort of thing, aren't they?
No, they are. So their VR capabilities, they acquired a VR developer who was effectively a games company before.
That's what they're in.
Before xReality.
That's the competition. So
it's a really good question, and there's no one thing you point to and say, that's their competitive edge where they smash everybody. It's all these little things that sort of add up, and overarching it all, like I said before, yes, the developers, their games and whatever, but it's a business run by SAS.
Yeah, I thought you were going to mention that.
So they know what their customers need. They know how.
They have a much more they basically are directing the.
They know where
software.
the gaps in their training systems are,
right?
And so come in. Second one is it's all real weaponry as well, and it doesn't sound like much, but it's not a game. You're not using a controller like a little plastic controller. No. You're putting sensors on your actual service weapons.
Oh, right.
Rifles,
So that's your
rifles, handguns, whatever it may be. So, you can be fully kitted out, wearing your service stuff with your service weapon, doing your simulated training. And the other one is it's mobile and doesn't require internet connection.
Okay.
So most of
that's a big deal.
most of their competitors, what they would do is
how can it not require internet connection?
so you can obviously you can connect to the internet, download scenarios,
Oh,
update,
right.
but then once you can then take it away,
Right.
and it's run. It's
Right.
run.
I see what you
on-
mean. Like it runs off.
It's running on an iPad
yeah.
or equivalent. So most of their competitors, what they would do is they would take a room like this and sort of put cameras around
Yeah.
and kit out a fixed location into a virtual training area, where Operator XR's come along and gone, you can do anything, any sort of open space can become a training area.
Yeah.
Because you don't need fixed cameras, fixed location. It's just all sensors and goggles and whatnot. So
Okay.
they've done a few things, but
Because I mean, we've all done those sort of those VR kind of like games where you go into a room and you're playing your friends and stuff. But this one goes to the next level.
It goes to the next level. Yeah, that's right. And so to wrap it all up, and I know this is something you're always focused on. First half report, cash flow positive, profitable as well. So they just hit that inflection.
And they've got a strong kind of. They don't have debt, or they don't have much debt.
They have a little bit of debt, but they're looking to sell those wind
Oh
tunnels.
yes. So that rings a bell.
That's a little catalyst that I'm keeping an eye out for. If they can sell those wind tunnels, they'll pay off the debt, get a bit of cash, and I think that's nice. But that Operator XR enterprise segment growing over 100% year on year.
Yeah.
And they also doubled their pipeline.
Yeah.
Because they're out there, talking to customers and trying to get them over the line.
Wow.
So.
Double. Lots of these companies, they come from such low bases that when they talk about doubling and tripling,
it is small. You're right. You're
really ever.
But they're based up in Manly, so we've got to get you up there.
It's all about cash flow positive. I mean, I definitely see myself being in the middle of a company visit. Trying out the real.
Get the goggles on.
Get the goggles on. And the last one, we've had a lot of people asking us about energy stocks for obvious reasons, with oil price going well through $100 or so. It came back the other night, but it could do anything by the time you're watching this. Where it goes, nobody knows. But with these oil stocks, we've long been supporters of Woodside, Karoon and Amplitude, but I would say that of those three, Amplitude is the best value, and it's not an oil stock, it's a gas stock. It has had a few issues recently that has sort of put the stock back a bit, but having said that, they had an exploration problem at one of the wells, so it was dry, Eleonora, I think, but then another one came out and it was positive, and they've got 2 more to go. So I think that this company, while there is a lot of risk there, they're providing gas to the Southeast Australia through the Otway Basin. They are producing record amounts from the Orbost plant, which is their plant, which they took over from APA. So there is a lot of, I guess, positives in that. They haven't got long-term contracts, so the prices they're receiving are closer to spot. Their balance sheet's strong. They've had the odd hiccup, so they're not too expensive. There is risk, but I think in that space, it's the best value from where we sit. I think definitely this whole scenario is going to play out and impact many of the companies we cover, if it keeps going. And it just shows the importance of having some hedges in your portfolio, including gold stocks, including oil and gas stocks, but it also shows the importance for ours of not paying up for those stocks. I know that you're not a resources specialist, Luke, but do you have any thoughts on?
Yeah, look, actually, I know this one a little bit. Back when it was the old Cooper Energy. Yeah. I owned it in a previous life at another fund I was at. It always sort of found a way to stub its toe.
Well, they've certainly had a lot of problems with that Orbost
yes,
plant. I mean, but it's funny how those problems didn't necessarily disappear, but were fixed when they took control of that plant. So I think that was the big
when it was run by APA
moment
that
we kind of got more confident in the stock.
Yeah, I think at the end of the day, I checked my watch before because I thought you almost got to put a timestamp on this. It's today it's Friday the 20th of March. The world could be vastly different by Monday next week.
We're all at the whims of some very
that's right
stable geniuses.
Are they? But I think one thing to keep in mind for people is, not all energy is created equal. So we know there's this energy crisis at the minute being driven by, the shutdown of oil exports through that Strait of Hormuz. But as you said, these guys, it's domestic gas production.
Yeah.
They'll benefit because you'll get some push-pull demand in other areas. And so I think it's a reasonable idea. But my caution to people is don't just look at a stock, because it's in the energy sector and assume it's a direct benefit of a higher oil price, because there's different types of oil, different jurisdictions, targeting different end markets at different prices. But no, look, it's one, like I said, it's been around for a very long time. They've been trying to get those fields and that production done, and I did flick open that announcement the other day where they said the Eleonora field wasn't as that was
a couple of weeks ago, and then a couple of weeks later they came out with another field that was actually very positive. So I mean, with these smaller stocks you have a lot more risk than with a Woodside, but
for sure, I
mean, but the bottom line is that the fundamentals of this company are strong in that they're producing 200 million plus of revenues. They've got their balance sheet's very strong. It's just and their sort of their contracts are short, so they can take advantage of sort of an increasing demand for gas.
Yeah, and you manage the risk through position sizing and that sort of stuff, I think. So, no, interesting one.
Well, thank you so much, Luke. They're all interesting stocks, and it's great exploring the ins and outs of them. And we hope to see you again soon. Thank you.